Hello everyone, this is a recap of the slides we presented in person a week ago on Saturday, May 5th at the 8th Annual Islamorada Investment Management Investor Meeting. We are recording this version of those same slides a week after the original meeting for those investors who couldn't make it in person. The meeting was actually the first live and in-person meeting we've held in a few years. As our client base has really grown beyond the Keys, we've tried to make sure as many investors as possible could see this material. So we've done the last two meetings online, but after Hurricane Irma hit the Keys last fall, I think it felt especially good to do this meeting in person again. First, the usual greeting from our compliance folks. And actually, while I think everybody knows Retz, who is on my right in this picture and who will be speaking a little bit later, since the last time we did an in-person meeting, Retz actually became a partner in the firm. A newer face to most of you is probably also our operations manager, Maria Mandozzi, who's on my left in this photo. Maria and her family moved full-time to Islamorada 2 years ago, or 3 years ago, I should say, and frankly, we were lucky to find her. Maria had spent a lot of time in the industry. She was previously for about a dozen years working in the high net worth groups of UBS and Morgan Stanley up in Aventura, Florida, and we were thrilled she could join us last summer. Her first day here was about 5 weeks before Hurricane Irma hit, and since then she's been asked to do a lot that we had no idea we'd need her to do originally, but she's absolutely a huge part of the team, and I hope you all get a chance to meet her or talk to her before too long. Agenda for today, here's what we want to cover. We're going to try to keep it relatively brief, considering it was only last October that we did the last annual meeting online. I'll talk a little bit about Tarpon and oil, sort of a condensed version. Retz will talk to her international portfolios. She's also then going to talk about the international market outlook. I'll jump back on, talk about U.S. market outlook, and then I'll review some new services that we're offering and going to be rolling out here at IIM as this year goes on. The slides I did, at least for Tarpon, for the last annual meeting last October, were about 2 hours worth of pretty detailed charts and graphs, really all about oil. I may do another deep dive again like that this coming fall, but today I wanted to hit pause on the overtly analytical stuff and sort of talk about things a level or two up from there. So a couple of things to put on the screen to start, and Tarpon's performance so far in 2018 is the first. You may remember from that last online meeting that after a huge year in 2016, we had a tough year in Tarpon in 2017 due to some pretty volatile oil prices. Last year also stung a bit more than usual because not only were we down, but the market as a whole had a really good year. Here, though, is what Tarpon has looked so far in 2018 through yesterday's market close, which in this slide is actually the 11th of May 2018. This slide has been updated compared to the one presented at the actual investor meeting a week ago. Again, I'm recording this video. This is early in the morning on Saturday, May 12th, and we held the annual meeting exactly 1 week ago. And the point is, both Tarpon and the S&P had a good week in the interim. In Tarpon's case, due to the U.S. withdrawing from the Iranian nuclear deal, which, while many things, is unequivocally bullish for oil prices, and which I'll talk more about a little bit later on. I'm hoping the rest of my comments on the slideshow here help underscore why I think we should soon start to significantly outperform the broader market for an extended period of time. In the meantime, in this snapshot, you can get a pretty good sense for the roller coaster that really is just investing in oil-related companies. Welcome to the party, as it were. It has been a volatile start to 2018 again, but we are staying stoic here. This is the process. It is a disciplined grind, but the fundamentals, really both for oil at a macro level and at our companies too, look excellent to me. The fact that the market has not completely recognized this yet, it's frustratingly beyond our control, but it's also a problem that should soon solve itself. I'll talk more about that in a bit. Here's a good quick shot of the volatility of oil prices. The chart of Tarpon over the last few years also looks kind of like this. It's almost seismographic. But while oil prices have fluctuated quite a bit, my rationale for sticking it out through all this volatility really is not. In a nutshell, I still believe the market is sleepwalking into a possible supply shock. Now, determining when that might happen is challenging, but in the bigger picture sense, unless we start seeing significantly higher oil prices really immediately, the small math problem we currently have in terms of supply and demand in the oil market could easily, in my mind, become a much larger problem. More on that in a bit here, too. So let's pause here and review big picture, where we are, how we got here, which I feel like it's important to remind us what we're trying to accomplish as we endure these ups and downs lately. So it was the end of 2015 that I made the decision to concentrate this portfolio in the energy sector and in oil companies specifically. That was coming up on 2.5 years at this point, although I think in some days it feels like dog years for sure. Now, however, I feel like we're right here in the oil cycle, right around that red circle, meaning we are through the worst of it, and we still have a long way to go until we reach the peak of the next cycle. Prior to late 2015, Tarpon had been somewhat more of a traditional, somewhat more diversified, at least by sector, portfolio of really my best ideas. Right out of that Warren Buffett playbook, we want meaningful stakes in good, undervalued companies with competitive advantages, excellent management teams, and we'd previously owned some financial companies that met those criteria, telecom, retailers, one or two gas companies along the way. We even owned Amazon for a little while, which, in retrospect, we clearly sold way too soon. But then we pivoted. We focused in on this one area. In November of 2015, you may remember, I wrote, it was about an 82-page investor letter. That was basically me saying, because the opportunities in this area of the market were just so much more attractive than anything else out there by far, we're going to do something that's a little unusual and focus in on the best opportunities we can just in this one area, the energy sector. And the short version of why that was so attractive is because this meltdown in oil prices was really a once-in-a-decade type of investing opportunity. As you may remember, oil prices went from a previous high of just north of $100 a barrel in late 2014 down to $26 a barrel briefly in February of 2016, all due to a 2% oversupply of oil in the market. Now, as a value investor, someone who actually reads companies' annual reports and quarterly filings and looks at balance sheets and follows the cash flows inside companies before we invest, that was really something I'd been waiting for since the last time this sort of thing happened back in late 2008 when I first launched Tarpon. That sort of earthquake, that sort of panic selling when other people just lose emotional control and sell their stocks at any price just because they have to get out, that's exactly where we want to be, stepping up and buying. And not doing it blindly, not doing it to be masochistic or just to be a contrarian for contrarian's sake, but because you could very literally buy dollar bills for, in some cases, as little as 10 cents. So the probability of achieving very high returns got very high itself all of a sudden. There are a handful of overlooked things about the energy sector that, as it turns out, I think can make it especially appealing to a fundamental value investor. I feel like if you call yourself a value investor, but you're not spending any time at all looking in the oil sector the last few years, especially among smaller companies, then your card to the club should get revoked or something. It's that unique a time, and this is sort of a top 10 list of why I felt like we're uniquely positioned to capitalize on this historic collapse in oil prices. The fact that these energy stocks are hated also makes them dirt cheap, and that's a pretty big important box to check, I think, if you're looking at things from a fundamental perspective. Contrary to popular belief, these companies do have competitive advantages. Not all of them, some of them. And those advantages are really in their rocks, the geology that they drill in. And number 3 there, management teams in this sector are really going to start finally seeing the importance of capital allocation. I don't think it's It's unfair at all to say that many management teams in oil companies, at least the younger ones, unconventional oil, historically had been pretty undisciplined, but discipline was going to be forced upon these companies as the distressed part of this whole cycle played out. Also important, but not on this list, I feel like is frankly just the competition, i.e., who we are buying our shares in these companies from. This slide may come across as a bit cocky, and that's not really my intent here. But I guess what I would try to say is, after watching this market daily for close to 3 years now, I feel pretty confident in telling you that most sort of quote unquote investors in the sector aren't really true investors at all. They're speculators and day traders. And I'm not saying that to disparage anybody. You could argue that last year, sort of from a very short-term point of view, well, maybe we should have acted more like day traders than long-term investors in some spots, I suppose. But, stepping back a little bit, my point is that among the humans that are left trading anything in this area of the market, the stuff that's not algorithmically driven or programmatic buying, I don't believe many of those humans or possibly those algorithms are really even looking at asset values or trying to attempt to buy fractional ownership stakes in companies and consider themselves partial long-term owners of anything. I can't prove it, but it sure feels like the vast majority of our competition seems to sort of be just looking at squiggles on a chart and trading. I'm not sure a lot of them are really even thinking as much as just reacting. And frankly, I don't even know if they have any really strong opinions. It oftentimes seems like, it's just an at-home casino or something for a lot of other folks in here. What our competition, I think, does seem to have is really emotional reactions to headlines amplified by really their own fears and misconceptions, which certainly makes things volatile, but in the long run, that will be good for us because of the opportunities it creates. In other words, if the time frame you're thinking about is years instead of weeks or months, I feel like we have very little serious competition when it comes to buying the shares of the most undervalued companies in the singularly most beaten up area of the market in years. So we can buy things at extremely low valuations, and the best predictor of your future returns, bar none, is the valuation you originally buy something at up front. And that's in all asset classes, from stocks to real estate to comic books to even Bitcoin. But that's a whole nother rant. In the meantime, this is really one of the most emotionally challenging parts of being a fundamental or a value investor, and that's having to personally reconcile what you see in the fundamental data with what you're seeing in your portfolios. That difference can at times, it can be confounding and frustrating to say the least, just because there is that big gap between your expectations and reality. The good news, I guess, in a sense, is that your portfolio manager is an emotional midget or something. So that sort of thing doesn't necessarily bother me that much at all, but I can certainly empathize. And bottom line, like I said, it's a problem that should self-correct and will self-correct, I believe, in the not too distant future here, finally. So the first question back in late 2015 was, is this downturn in oil prices going to be temporary? And in the end, the answer was pretty clear, at least to me, yes, it's going to be temporary. Among other things, this industry will always be cyclical, and this time would be no different. Then the second question is, okay, if that is true, is there a systematic way that we can really exploit the coming rebound in oil prices? And not surprisingly, yes, I think there is. To do that, we want to identify the best managed companies with the best rocks and the most viable path to significant long-term gains. Sort of a lot to unpack there, but in the analytical sense, we want to align ourselves with companies that would be the most geared to an increasing oil price because of the operating and or financial leverage in their businesses, and or because they would see significant expansion in their reserves. Reserves being those oily assets that ultimately drove their earnings. And those reserves would expand both through increased oil prices, acquisitions, and or in some cases proving the viability of other reserves that they already owned. All right, threw a lot at you there. Let me step back for a minute. In the big picture sense, it's the assets that a company owns, or even that you own as a person, as an individual, that are going to drive your future earnings potential. For instance, if one of the intangible assets you happen to own is a diploma from the Harvard Law School, or if you're the only plumber for 100 miles around in a town of 10,000 people, you're probably going to be able to convert either of those assets into high earnings over time. I'm arguing it's the same concept for oil companies, only the assets aren't diplomas or monopoly businesses. They are rocks, specifically, again, the geology of the land that they lease. And it's even easier for an outsider to quickly gauge how valuable those assets might be because these companies have to tell you. So stepping back again a little bit, it's a company's assets on the balance sheet that ultimately drive that company's earnings on the income statement. And if those earnings are then what the market is going to use to assign and assess a value to the overall company, then it doesn't take a genius to figure out that much higher oil prices are going to increase asset values, dramatically improve profits, and ultimately result in much higher company valuations. Technically, in the oil business, it's not the company that tells you what its assets are worth. It's the independent engineers that audit an oil company's reserves every year. And based on a number of assumptions, those guys will literally tell you how much the conversion of that company's assets over time will be worth today in something called PV10. That number, in brief, it will change modestly in some circumstances, specifically as oil prices rise. Then the cash flows from a company's existing oil reserves will increase too. But in other cases, in other circumstances, you can see some Lollapalooza type changes if at the same time oil prices are rising, the size of the company's total asset base grows too. Either because the company buys high quality assets at good prices in the depths of the downturn, or because they prove that the other assets they already own are really worth a lot more and they're going to start monetizing them soon too. So there are a number of different ways to value oil companies, each with its own set of sort of acronyms and nuance. But to start, you can pretty quickly tell whether a company might be worth looking a lot closer at and spending a lot more time on by really doing some back-of-the-envelope number crunching using just sort of an adjusted version of that PV10 number the independent engineers come up with, and frankly that these companies put out really in every presentation they have. One of the most common questions I've gotten lately is basically this. Oil has been rallying nicely here. Why haven't the stock prices of our oil stocks moved up in lockstep too? I call this the valuation lag, and as it turns out in 2017 we saw the largest divergence between energy stocks and oil prices in the 30 years that this sort of thing has been tracked. Up until about 4 or 5 weeks ago, many small oil companies were trading at valuations that were similar to when oil prices were at $26 a barrel. Only at that point, a month ago, oil was at $60 a barrel instead. So why is that? And the short answer is it's sentiment. It's negative sentiment that is causing that valuation lag. But again, the good news, it should correct in our favor before too much longer. And soon I'll show you some signs that it is actually, it may have in fact started shifting to the positive about a month ago. A lot of investors still just hate this sector, probably because of something called recency bias. When you incorrectly believe that whatever the market has been doing recently is just going to continue. Everybody remembers the oil crash and is overly cautious. They seem to feel like the market is going to crash again when, insert your own bearish argument here happens. Also, there are a lot of shorts, frankly. There are a lot of short sellers who have just been camped out in these shares for a long time. So you've got some technical factors which can keep prices depressed in spite of good fundamentals for longer than you might expect to. I kind of think of it as if investors had, just had a really bad breakup with energy stocks. Things got thrown around the room. Numbers got deleted from phones, the whole 9 yards. They got burned. They will be back. It's going to take some time for the market to earn their trust back. And unlike value investors, those folks will really be happy to buy those shares back again at levels even higher than today. The other source of that horrible sentiment could also be the perception that U.S. oil production is going to continue to climb rapidly and flood the market with oil. It's kind of a longer discussion. I feel like I got into a lot more last October. Longer discussion about why that's not going to happen. And incidentally, we are seeing some real bottlenecks develop in the Permian Basin in West Texas that are going to throttle oil production, which is bullish for prices. If that is a valid concern, to the extent that it is, then, well, my take is, well, the flip side has also got to be true, right? Drillers' valuations can increase rapidly if the perception once again becomes that U.S. shale will not be able to cap global oil prices at low levels. So as WTI oil prices keep climbing higher, more people may finally be forced to sort of reckon with and realize that that was just kind of bad math to begin with. So the outperformance in stocks I'm expecting will likely come after the commodity reaches a new level and hovers there for a while. WTI is at about 70 right now. I would sort of prefer it stabilize here and just get a little bit of frankly, stability to things. I think that's probably better for us in the long term than if it spikes, if oil prices spike, excuse me. So we could be at that inflection point right now, which does mean that after things stabilize and people sort of recalibrate, there is the potential for what could be a violent rally in energy stocks before too long to sort of close this gap that developed on this particular slide here. That said, even if for whatever reason that sort of day or period of reckoning gets pushed out further, we should still do really, really well, even if it takes longer to happen than we might otherwise think. All of which brings me to this. This is a hypothetical example. If we buy shares in an oil company trading at half of what it's really worth, and if its value grows 12% a year through retained earnings, say due solely to increased oil prices, and if its share price finally rises to reflect that company's true corporate worth in the 5th year, then at the end of that investment will have compounded at 29% per year. It also turns out that 2/3 of that ultimate return comes from the gap between price and value closing, and only 1/3 comes from the increase in business value that, in this hypothetical example, we're saying is driven by increased oil prices. So that's a very simplified proof that stocks purchased at prices significantly less than their intrinsic worth can appreciate substantially once the market recognizes the company's true economic value, even in the oil market, and even if that takes a while. The point is that if you can stay patient and just grind it out, even during the times when the market is frustratingly slow to recognize the real value in a particular company, then we will still be rewarded handsomely at some point. Now, all that said, in the practical sense, I realize I don't have forever to prove to you all that this focus on oil has actually been a really good idea. You're all probably tired of the volatility, and in that sense, I realize we can't keep doing this forever. But let's not give up yet. The good news is that sentiment seems to finally be shifting. Finally, it seems like others are starting to realize what I've been trying to say, and a few others have been trying to say for a while. Here are a couple of recent headlines that some of you all sent to me the last few weeks. At the end of 2015, I thought we'd be back to at least $80 barrel oil by last fall, a couple years. I was wrong, and really specifically because last year I didn't anticipate OPEC temporarily boosting their own production in late 2016 to lock in higher levels of production going into their production freeze agreement. That hurt us last year for sure. Still, we were able to take advantage of things last year by swapping out a few good cheap companies for a few good, even cheaper companies, if that makes sense. The other good news is that it's looking more and more likely that we will see $100 oil again within the next year or so. The timing of all this has clearly been a challenge. It's a complex equation, a lot of variables, but that broader conclusion remains the same. Specifically, the world is at increasing risk of sleepwalking into a supply shock in the not too distant future. And I say that because fundamentals are very favorable here. Specifically, oil inventories are really evaporating at a historically unprecedented level around the world. There has been, by some counts, about $1 trillion in capital expenditures and maintenance that has not been done on oil fields around the world the last few years. The market remains overly obsessed with U.S. shale production growth, even though it only represents 5% of the overall oil market. And incidentally, while other more significant production sources overseas are clearly faltering. And last but not least, because Saudi Arabia appears to want to see oil significantly higher too. Let me step back a bit again. So two different but related concepts when it comes to oil. There is real-time supply and demand on a daily basis, and then there is oil sitting in inventories, oil that's sitting in tanks around the world, essentially. Right now, in real time, the market is most likely undersupplied by about 700,000 barrels of oil per day. So there is not enough supply to meet demand on a real-time basis today, right now. And now it's hard to say how much that deficit is exactly, because most of the data that's used to come up with that is on a lag. It can be hard to definitively prove. Nonetheless, you can still make pretty confident estimates that it's between, call it 500,000 and 1 million barrels of oil a day that the world is currently short. Again, that's right now. The reason that this doesn't seem more widely known, however, is because of the oil that has been sitting around inventory. That oil that's been sitting in tanks has been getting pulled out and injected into the market every day, so that 700,000 barrel a day shortage really gets masked. And so one of the more interesting questions all this is, okay, well, when is the market going to figure this out? I suspect that given the historic rate at which inventories have declined the last year, it's going to be pretty obvious by this summer, when demand for oil, incidentally, also steps up big time around the world, and global inventories look like they're going to fall below the level that they were 5 years ago, when oil was at $100 a barrel. So let's see how the summer goes, and we'll take things from there. I think another interesting question is, in spite of a lot of volatility and ostensibly a lot of angst, okay, well, what if this all goes right? Somewhere on this table will be our reward for sticking it out. This is, you may recognize this slide. I included it in the last October version. It has not been updated in the spirit of true disclosure. There's a lot that goes on in this slide. It's fairly time-consuming, and frankly, I just have not updated it yet with more recent share prices. But I feel like that's still okay. It's more of the big picture than the actual point estimates anyways. And again, if you don't recall, this shows, in my mind, what the expected returns for Tarpon are at various oil prices. You can see that at the top of that table. And then on the left-hand side, that column, some common valuation multiples that U.S. oil E&Ps merit under certain circumstances. So each line should be thought of independently. For instance, if oil is $55 a barrel and an appropriate EV to EBITDA multiple is 5x, then sort of right there and near the middle of the screen, then we would expect Tarpon return 33% for us, that sort of thing. So this table, I feel like, highlights a couple things, one of which is the potential for truly asymmetric returns. And frankly, some of these outcomes, they may look too good to be true, but I would tell you that we've gotten a couple of data points already that confirm that this strategy of being a stubborn fool, the strategy of focusing on undervalued small oil companies, could in fact be highly profitable for us, and that's my expectation, frankly. Specifically, those data points are, as you may recall, back in 2016, we had two 10-baggers in Tarpon, two companies whose share prices went up more than 1,000% in a single year, which among a lot of things, I feel like is a pretty good justification to stick with this, being a stubborn fool strategy a little bit longer here. Another common question I've got is basically, all right, what's the plan? It's been awful volatile. It'd be nice to start thinking about when we're going to be done with this volatility and move on from all this up and down. And so this is my attempt to address that. If I were you, an investor here, I think what I would probably want to hear from me is that something along the lines of, we're going to get out the day that oil hits $100 a barrel. But I'm going to be hesitant to say that. Instead, I will say this. We'll be exiting when the data says supply is meeting demand in the oil market, and our companies have reached their fair values at whatever oil price that might be. I want to be a partial owner of these businesses for the next leg of this oil cycle, full stop, and I want us to realize the highest possible increase in valuation of our fractional stakes in those companies over that time period, if that makes sense. I agree, or I concede that it's tempting to think about our exit in terms of an explicit oil price, but I am resisting that temptation, and let me try to briefly explain why. The first reason is because, there may be that lag between oil prices and the valuations of our companies. It could persist, and if, say, oil hits $100 a barrel, it might be a quarter or two or three before that really shows up in the valuations and share prices of our companies. Second, and this is really the more important factor here, I really don't want to take too lightly the prospect of foregoing truly significant long-term gains. As Charlie Munger once said, that the first rule of compounding is never to interrupt it unnecessarily. It can be hard to articulate the value of the exponential function on a portfolio's growth. I guess maybe got a glimpse of that a couple slides ago in that table of asymmetric returns. But to me, this is what investing is really all about. It's sort of that search for the most potentially life-changing, long-term compounded returns safely possible, period. We may have that chance to truly compound things for a long time with some of these companies. The obvious problem being that this is, an inherently cyclical industry, and frankly, none of us want to be around to see paper losses of 50% once we're over the top and looking, at the next down cycle. I'm still chewing on what that means in Tarpon specifically. I'll probably have more to update you on soon on that front, but for now, to summarize, I would say we're going to get out as deliberately as we got in. And while I know some of you are probably ready to get off the volatility train, what I'm saying is let's not forego some truly significant gains the next few years just because you're tired of the volatility today. Let me be tired. You go enjoy your lives, and my hair was already turning gray. Okay, two near-term events that might cause oil to rise either further or ostensibly faster than expected. That first one there, the Iran deal being nixed, that's already happened. Again, 1 week ago at the annual meeting, I noted that on May 12th, which is incidentally today, the day I'm recording this, that President Trump seemed highly likely to decertify the Iran deal, the JCPOA. And today, as I record this video, again, it is May 12th, and the president did back the U.S. out of that deal. So this potential catalyst has actually materialized, and it is unequivocally bullish for oil. Iran is OPEC's third largest producer. It exports 2.5 million barrels a day. Sanctions are now in the process of snapping back, and in the end, I believe that in spite of the best efforts of some of the other parties to that deal, most of the world is going to have to reduce their imports of Iranian oil. And that could remove, on the conservative side, anywhere from 200K to 300K barrels of oil per day in the near term, and potentially double that over the next year or so. A little bit uncertainty about it, but the bottom line is this is going to further increase that real-time supply deficit we are currently in. Second near-term catalyst, this humanitarian crisis in Venezuela, it also continues to impact their national oil industry. Over the last 30 months or so, production has fallen sharply by about 870,000 barrels of oil per day. Those declines are accelerating. The former head of the Venezuelan National Oil Company said about a week ago that he could see production falling another 600,000 barrels of oil per day by the end of this year. I just struggle to see how production out of Venezuela is not going to continue to just decline substantially from here. This issue is also, at least to me, a more significant potential surprise than the Iran deal because it's simply not getting nearly enough attention. Here in South Florida, because of the large Venezuelan community up in Miami, it seems like we've been really seeing disturbing headlines in the Herald about it for years now. But my sense is that, from a broader scope, it seems oddly underreported when it comes to the oil market impact specifically for some reason. Neither reduction in supply, either Iran or Venezuela, was figured at all into most analyst models at the beginning of this year. So again, to reiterate, both are very bullish for oil. On a daily supply-demand basis, again, we're already in a deficit, probably around that 700,000 barrel a day level, and that's likely to grow significantly this year, even before you start to factor in Iranian sanctions and Venezuela's unfortunate problems. So again, this could be a very interesting summer. Let's see what happens. Some quick looks at a couple of specific Tarpon names, and again, these are sort of representative of some of my best attempts to maximally compound our capital as safely as possible. The fact that these companies are unknown and or ugly, that's kind of the whole point. That is where the best values are, at least in my mind. Okay, Contango. Excuse me. I wrote them up about a year ago in a letter to you all. I feel like they're probably sort of the best, most undervalued stock among all very small U.S. oil production companies. They're trading at less than 4 times expected cash flow for this year. And at these prices, you're literally paying nothing for 5,000 prime acres near the heart of the best U.S. oil acreage in North America, the Permian Basin of West Texas. In fact, if you bought the entire company and sold all its assets off, the cash you'd get back would be about double what you paid to buy it. The market is valuing the share price as if the company would be worth about twice as much right now if you just liquidate it, which obviously doesn't make any sense. Contango has actually had a good year operationally compared to that write-up I put out a year ago. But the stock price really got crushed in the last 3 months of last year because a bigger private equity fund that previously held a large number of Contango shares, among other stocks, that private equity fund closed and it liquidated all its stock holdings, including Contango shares. So the fund blew those shares out. Smaller company, not a ton of liquidity. Because the fund was closing and didn't particularly care what price it got on the shares, it sold a lot over a long time, really being fundamentally unconcerned if and when buyers are going to step up. And the short version is that the stock really cratered. And I point that out because, that sort of development doesn't have much to do with the company's prospects or current operations, even though it obviously impacts shareholders like us in the short term. And B, that share price decline shouldn't be confused with a change in the underlying asset value or safety even of Contango, which, ironically, in my mind, it's increased in value as we've owned it due to the successful drilling efforts of one of its partners there in South Texas. So all of which is why we're still sitting here on these shares. I haven't sold anything or even adding some more occasionally in spite of the paper loss to date. The company is, at the end of the day, as undervalued as it's ever been, and there are some clear catalysts which should unlock that value not too far out on the horizon. Also, for whatever it's worth, the CFO of Contango, he's a Miami guy. He previously lived in Miami for a number of years. He actually returns phone calls from guys in the Keys, and the short version is I am comfortable with our holdings there still. Contango stock trades at under $4 now, and never mind, what I think it's worth as per that letter I put out a year ago. If you just Google or find the company's latest presentation, you'll find a slide in there that shows why management thinks shares are really worth closer to $24 each on a net asset value basis. Ensco, this is a company that owns and leases offshore drilling rigs, trades at 20% of book value, roughly. That book value is a solid number, by the way. Short version is offshore drilling in general has just gotten decimated in this oil downturn. It costs more, as you can imagine, to get oil out of offshore fields. So that's really the first line item to get cut when doing a big corporate budget when oil is hitting $26 a barrel. Nonetheless, in the end, the world is still going to need offshore oil fields too to meet the demand for oil. It's just a math issue. Ensco, in my mind, is easily the best positioned company, having acquired a rival with excellent assets right at the bottom of the cycle. To step back, to say something is trading at 20% of book, it's anomalous to seeing a perfectly good house that's really worth $1 million, but which you could buy for $200,000 in cash. If you just bought the house and never even stepped foot in it, you never even crack open the front door, but just waited for the people in that neighborhood to sort of come to their senses, you'd quintuple your money. Shares of Ensco are $6 a piece, and just using their book as a proxy, never mind what I might think, just using their book as a proxy, book value, they're worth closer to $30 each as the upcycle in oil continues. Energy 21, originally included them in the presentation because I felt like they're a really good example of creating value versus increasing reserves, like I mentioned in those few slides earlier. PV10 reserve value for the company is $135 million based on their last annual report, which incidentally assumed $41 barrel WTI. WTI trades near 70 right now, but even if you use an average of $58 a barrel WTI for all of 2018, just to keep things conservative, Energy 21's proved reserves, look like they could jump to about $1.4 billion at the end of this year. That's about a 10x increase in assets, assuming a few things which seem highly likely to occur. Every $1 increase in oil prices is worth about $10 million in cash flow to the company, so very leveraged, which is good in this part of the upcycle to oil prices. The stock's about $6 now, and I believe it's worth closer to $30 in 2019 if oil can stay north of $75 for that time, which I feel like is a high probability event. Now, there's a little footnote at the bottom of this slide. I should note that between the time I originally presented this slide at the actual annual meeting last week and today, when I'm recording this video, Energy 21 announced a significant and pretty complex proposed deal that they are considering doing. They announced it along with their earnings report last Thursday. The deal involved offloading a big chunk of some of their future liabilities to a third party, resulting in some significant cost savings, essentially in exchange for a piece of the company. That deal has to be voted on in Q3, so nothing official yet, but it was certainly pretty interesting to consider. To summarize my thoughts on that new development, first of all, the drilling results the company reported for the quarter were quite good and essentially reinforced that whole increase in reserve-based thesis again. By my calculations, that proposed deal valued Energy 21 at approximately $10.80 per share, which is significantly higher than where we are right now. So you've got ostensibly a very informed investing group on the other side of this deal, and they're saying, all right, well, right now, given I'm presuming some what will look like conservative assumptions in the oil price strip, they're saying it's worth about $11 a share in theory. In a nutshell, that deal, if it goes through, essentially in my mind, essentially de-risks the company in exchange for trading off some of that $30 per share upside. So if the deal gets approved, instead of Energy 21 being worth $30 a share in 2019, again assuming oil stabilizes here, it might mean shares are worth closer to, call it $17 each at the end of 2018, again depending on oil prices, that sort of thing. So I like the deal. We're hanging on to our shares, specifically because at the end of the day, it's good for the company. It really represents, in my mind, it's synonymous to a short-term put option, which means specifically, if oil prices fall in the next 2 months, I don't expect them to, but if they do, then shareholders in Q3, when we vote, will probably vote to keep this deal. It's protective in that sense. If oil prices stabilize or even continue to rise, though, that deal will likely get scrapped, and then we keep all of that $30 a share in upside. My hunch is also that the announcement of this deal by the company it's probably like shooting a flare to get the attention of activist investors, who, if some do step up and respond, would also share the same take as I think we do on this, again, which would be another positive for the shares if that were to occur. Anyway, those are just 3 examples of some, frankly, just crazy undervaluations that are out there right now. The names in the rest of Tarpon are basically the same. Each is very case by case, and the circumstances differ, obviously. But the general theme, I guess, is this is a fairly unique opportunity. And in spite of all the volatility and heartache along the way, I believe it's going to be worth it and then some to grind it out here. Again, while it's not clear when the market exactly is going to sort of wake up to these deals, I'm okay waiting a little bit longer for it to happen, because when it does, again, it could be it will certainly be a significant rally. It could be even a violent rally over a shorter period of time too. We'll just have to wait and see. Here's the final question I get a lot. Where will oil prices be, for instance, at the end of this year? I am not in the forecasting business. I'm going to hedge a little bit and probably give you an unsatisfactory answer, but just bear with me. This quote, this is the answer from the head of Saudi Arabia's oil industry, probably, arguably, the most important single individual in the entire industry. So I put that up there because my own, sort of probably unsatisfying but still technically correct answer to that question is, the price of oil will go to whatever the price is that brings supply in line with demand. That could be $80 a barrel, could be $100 a barrel, it could be $125 a barrel. But to expect oil to stop right at that marginal cost barrel at $75 or $80 a barrel, I feel like that's just naive. The price is just as likely to overshoot on the way back up as it did 2 years ago on the way back down. All that said, perhaps an even better answer is in here. This is a story which showed up in the Wall Street Journal the afternoon before I was finishing, the original annual meeting slides. Apparently, Saudi wants to see oil at $80 a barrel specifically by the end of this year, ostensibly because they're going to be IPOing. They're going to take their massive Saudi Aramco company public, and they want to maximize the value they get for it, which is perfectly rational. Anyways, I feel like this is really intriguing. I would not personally want to fight Saudi on this point. So again, this could be an interesting summer. Let's stay tuned and see what happens again. Anyway, that's all I've got for now. Thanks for the patience during all this. I still believe strongly this is all going to be worth it and then some before too much longer. Please stay tuned, and if it's helpful, let me know. We can do another sort of deep dive update on oil in one of these similar narrated slideshows in later summer, early fall too, if it's helpful. And with that, I'm going to turn things over to Rhett for a bit, and then I'll be back. Thank you.